Welcome to the Ring of Knowledge, your trusted source of financial and practical knowledge. Today, we take a closer look at one of the most talked about topics in the world of finance, the tumultuous journey of Amazon stock. Investing in Amazon stock is a topic that has been on the minds of many investors. Amazon stock has had a rough journey, and after reaching its pinnacle in November 2021, the e-commerce behemoth has been on a downward trajectory, lagging far behind the overall market by a significant margin. In fact, its performance has been 3 times worse than the market average, raising concerns among investors. However, could the future hold a different narrative for Amazon stock? It's not outside the realm of possibility. Despite the current market trends, there are various fundamental and technical aspects that could impact Amazon's stock trajectory in 2023 and beyond. With its vast reach and unparalleled customer base, Amazon's potential for growth remains significant, and it's essential to explore the underlying factors that could influence its future performance. In this video, we'll dive deep into the market and economic factors that could impact Amazon's future prospects, including the company's financial statements, macroeconomic trends, and competition within the e-commerce space. By gaining a comprehensive understanding of these factors, we can make informed predictions about Amazon's stock performance and help investors make wise investment decisions. So, without further ado, let's begin our exploration of Amazon's stock trajectory in 2023 and beyond and see what the future holds for this e-commerce giant. Decline of Amazon stock. The fortunes of Amazon stock have seen a steady decline since its peak in November 2021, and its performance has been severely lagging behind that of the overall market. If investors are hoping for a reversal of this trend in 2023, they will need to consider both fundamental and technical factors. The company has a long history of delivering substantial positive free cash flow, or FCF, each quarter, with some quarters even exceeding $15 billion. However, in recent times, FCF has mostly been negative, with the exception of Q4 21. This trend is made even more concerning by the fact that Amazon's financials have taken a turn for the worst, with its financial debt to EBITDA ratio reaching its highest point in a decade. Investors are less likely to pay premium prices for a stock when the company has negative cash flows and an increasing debt load, especially when there is a general air of risk aversion. Furthermore, Amazon does not offer a dividend to offset any losses, which could have provided some relief. The conversion of sales into operating cash flow has slowed down in recent times, with the average number of conversions now at its lowest point in 5 years. This trend can be attributed to the company's inability to control variable costs per unit, as well as an increase in fixed costs without a corresponding growth in revenue. Operating margins, which were previously around 5% per quarter on average, have now fallen to less than 2%. Additionally, working capital has been moving in the wrong direction, and operating profits have declined. Amazon has always been in a strong position in this regard, as its receivables and inventories are typically slower than its payables. However, the company has recently moved away from this long-term average. A significant amount of money has been invested in network infrastructure, which has impacted the FCF. The management overestimated the market's appetite for such investments after the pandemic and doubled the size of the networks, resulting in a slowing of the FCF. The fixed asset turnover ratio, which was previously close to 4 times, is now just over 2 times, which is approximately half of what it was before the pandemic. Revitalizing Amazon's performance. Mistakes may have been made in the past, but the company is committed to rectifying the situation. To begin with, the company has made a conscious decision to reduce the CAPEX budget by 1/3, reducing the amount allocated towards fulfilling the network and transportation needs by $10 billion. Although investments in AWS may still have an impact on the cash flow, the CAPEX budget for the current financial year is set to increase, with the focus on leveraging the high fixed cost base to boost usage. The chief financial officer has shared that the company is working to restore the cost structure to pre-pandemic levels, which is expected to lead an improvement in operating margins and bring them back to their historical average. In November 2021, rumors circulated about Amazon potentially laying off 10,000 employees. However, recent reports suggest that the number could be as high as 20,000, which would have a positive impact on per-employee metrics, as this could represent more than 10% of the corporate staff. During the 3rd quarter of 2021, Amazon had already implemented cost-cutting measures and increased productivity by $1 billion and the company's management has stated that they expect to see further improvements in the coming quarters, with a potential $1.5 billion in productivity gains in the second and third quarters. The company's strong position with regards to working capital is also expected to positively contribute to the operating cash flows, as the company holds a large inventory and does not need to make any further purchases. As the cash conversion cycle returns to its historical levels, the amount of operating cash flow is expected to increase. Amazon stock price trend analysis. Between the years 2019 and 2020, the stock price remained within the range of $80 to $100 for an extended period of time. Upon the conclusion of the pandemic, a bullish flag formation was established. The stock attempted to break out of this flag formation twice in July 2021 and November 2021, but ultimately resulted in a bearish double top pattern around the $180 level. Subsequently, the stock price has been declining, and the flag pattern broke down in April 2022. Despite an initial recovery with a rounding bottom formation, the stock suffered another prolonged drop. Over the past 17 weeks, the majority of the candles have been large and red, leading to a one-dimensional downward trend. However, it is possible that there could be a shift towards less selling and more consolidation within the congestion zone of $80 to $100, which was established in 2019. Adding to the potential for a bottom, the stock no longer appears to be significantly overvalued compared to its peers in the NASDAQ and the retail industry. In recent months, the theme of mean reversion to the downside has been prevalent, which was once considered to be unlikely. Currently, the stock is trading slightly below the midpoint of its long-term range in comparison to the NASDAQ and the VanEck Vectors Retail ETF. Should you buy Amazon stock, sell it, or keep it? Despite some lingering issues that Amazon needs to address, one cannot help but ponder whether the current market price already takes into account many of the potential risks. In recent months, there have been significant cuts made to the estimated earnings per share, or EPS, and revenue projections for December 2023, with EPS predictions being lowered by 25% and revenue projections being decreased by 6% from their previous projections. At first glance, one might consider the forward PE valuations to be rather steep, given the substantial reductions in denominators. However, the overwhelming amount of selling in the market has made the PE ratios appear quite attractive. To be specific, the stock's forward PE ratio based on the projected financial year 2023 numbers is almost at the lower limit of its 5-year forward PE range of 49.86 to 98.63, and is currently 32% less expensive than the average 5-year forward PE of 74.61 times. In conclusion, it could be argued that the downside risks are not pronounced as they were a few months ago, and there is a likelihood that the stock could form a stable base around its current value. This could provide investors with some exciting opportunities to invest in Amazon, as the forward valuations are already relatively low compared to the average over the past 100 years. With all factors considered, Amazon presents itself as a compelling stock to buy. Why Amazon is poised for a significant 2023 comeback. A recent note from a JP Morgan Chase industry analyst has labeled Amazon as a top investment pick, highlighting the possibility of a recovery in the retail sector after a challenging year in 2022. Despite the difficulties faced by the company, largely due to external factors, there are several reasons to believe that Amazon may return to being a darling of the stock market in 2023. A rebound in profitability. The past year has seen the U.S. economy impacted by inflation, and Amazon was not immune to its effects. The company's operating profit margin experienced a significant decline, with management attributing this drop to the inflation of business costs, inefficiencies in the fulfillment network following expansion, and increasing fuel and freight expenses. These factors resulted in substantial losses, with negative free cash flow of $29.7 billion over the past year, and a 35% decrease in the company's stock value from its high. However, there are reasons for hope. During the second quarter of 2022, 57% of items sold in the e-commerce segment on Amazon came from third-party sellers, a record high. Third-party sellers are independent vendors who pay Amazon for access to its marketplace, and their growth can alleviate some of the company's financial burden, making it more agile. If this trend continues, it could help stabilize Amazon's profitability. Additionally, the Federal Open Market Committee, responsible for setting monetary policy in the U.S., is increasing the federal funds rate to curb inflation. Investors can expect to see Amazon's profit margins stabilize and eventually rebound as inflation comes under control in the coming quarters. The dominance of AWS. While many retailers face similar challenges, few have a business like Amazon Web Services, AWS, in their arsenal. AWS is Amazon's public cloud platform, and it is the company's fastest growing and most profitable segment. In the second quarter of 2022, AWS revenue increased by 33% year over year to $19.7 billion, and operating income from AWS reached $5.7 billion with an operating margin of 29%, far higher than Amazon's overall 2.7%. AWS contributed 100% of the company's operating profits in the quarter, making it a crucial part of Amazon's financials. The company anticipates continued long-term growth for AWS, which will only further boost its bottom line. A stock market bargain. Investors now have the opportunity to reassess the company's stock valuation. Currently trading at a price-to-sales ratio of 2.5, the stock is close to its cheapest level since 2016. AWS was only 9% of sales in 2016 compared to 13% in 2021, and is expected to become an even larger portion of the business as its growth outpaces retail. The retail segment, while still making up the majority of revenue, serves primarily as a gateway to drive users into the Amazon ecosystem, with online shopping translating to other business areas such as Prime subscriptions, Prime Video, advertising, and more. As long as operating margins stabilize, the company is likely to see an end to recent cash losses. In conclusion, despite the current challenges facing the business, Amazon remains a leader in both e-commerce and cloud computing and is one of the largest tech companies in the world. It is likely that Wall Street will view 2022 as a year to buy the stock at a great price, as Amazon looks primed for a significant comeback in 2023. Is Amazon stock a wise investment for 2023? The road ahead for Amazon stock has been anything but smooth. In fact, it's been on a downward trend since reaching its peak in November 2021 and has underperformed the broader markets by a staggering 3 times. But is 2023 the year for a change of fortune for this retail giant? Here's what you need to know. The challenges. There's no denying that Amazon has faced its fair share of hurdles, and regaining investor confidence is key. One of the primary concerns has been the negative cash flow in recent quarters, with the exception of Q4 21. Additionally, the company's financial debt to EBITDA ratio is at its highest in a decade, which has raised some red flags. Another issue lies in the slumping conversion of sales to operating cash flow. Historically, the conversions were in double digits, but now they're at their lowest point in 5 years. This is due to the company's inability to control variable costs per unit and a surge in fixed costs, which has resulted in lower operating margins. The working capital dynamics have also been a challenge, as Amazon's negative cash conversion cycle is pulled away from the long-term average. Over-investment in network infrastructure has also impacted the FCF dynamics, with the fixed asset turnover ratio halving from 4 times to 2 times. The outlook. The good news is that the company appears to recognize its mistakes and is working towards rectifying them. The CAPEX estimates for the year have been reduced by 1/3, and investments in fulfillment and transportation are expected to dip by $10 billion. The company is also focusing on leveraging its elevated fixed cost base and improving utilization. The CFO has also mentioned getting the cost structure back to pre-pandemic levels, which could lead to operating margins converging towards the long-term average. The workforce could be reduced by 20,000 employees, which could improve per-employee metrics. Productivity improvements and cost efficiencies in the network are expected to continue, with the management stating they expect to see further improvement in the quarters ahead. Working capital is also expected to make a positive contribution to operating cash flows, as the company is well stocked with inventories. As the cash conversion cycle returns to historical levels, operating cash flow generation should increase. Technical considerations. Although the recent price imprints on Amazon's weekly charts don't look promising, don't give up hope just yet. Between 2019 and 2020, the stock consolidated around the $80 to $100 levels, and after a pandemic breakout, it formed a bullish flag. However, 2 attempts to break out of the flag in 2021 were unsuccessful, leading to a bearish double top and a downtrend. But with the right moves and improvements, there's potential for a turnaround. And that concludes our deep dive into the tumultuous journey of Amazon stock and its potential for growth in 2023 and beyond. As always, we hope that this video has provided you with valuable insights and helped you make informed decisions about your investments. Remember, investing is a long-term game, and it's essential to keep a level head and not get swayed by short-term fluctuations in the market. With Amazon's vast reach and dominant position in e-commerce and cloud computing, there's a lot of potential for growth in the years to come. As always, do your due diligence and invest wisely. Thank you for watching, and we'll see you in the next one.